Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Covered Calls and Short Puts. And today we are going to be talking about covered calls, but I wanted to address the question, how much is enough? How much is enough potential income from a covered call that we're selling, and how might a trader seek more? How can we restructure the trade to deliver a higher potential for reward? Also, what are the pros and the cons of doing that? Quite a bit to cover. But I'm going to be going through 3 different ways to increase the potential for income from a covered call. Talk about how a trader might decide for themselves whether that's sufficient income potential or not. Now, before we get to any of all that, let me first of all say hello to everybody who's already chatting in. Great to see all the familiar names out there in YouTube. Great to see any new names that happen to be out there. But hello there, JDLMI, Veer9034, Will, Rojo, JRTR, E. Dunny, Paul, John, Mark, the other Paul. Everybody, thanks for joining us week after week. Always appreciate your attendance and your contributions here. If you are here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, we'll enjoy the recording. As I always say, the great way to watch these webcasts, but you are certainly invited to join us here in the live stream if you'd like to be here in our live audience. This is a Monday webcast series. We kick things off promptly at 2 Eastern time. All right, now I also want to let my live stream audience members know that my very good friend Brent Moores is going to be hanging out in the chats. He's going to be addressing any questions that I can't get to. Brent and I have now literally worked together for more than 20 years. So Brent brings a ton of experience to this. Thanks for having my back there, Brent. Brent and I would also like to issue an invitation to everybody listening to follow your favorite Schwab presenters on social media. You can find Brent and me on X. You can find Brent there at Brent Moores CS. You can also find and follow me on X at Cameron May CS. Now, in addition to that, as of a couple of months ago, you can also follow me on LinkedIn. I post there regularly. I check the comments there. But you can find me on LinkedIn. Go to linkedin.com/in and then /Cameron May CS. CS for Charles Schwab is my handle there. But let's get into this discussion. How do we increase the potential for income from a covered call? What might be the pros and cons? How might we determine when it's sufficient? A lot to cover, but before we do that, bear this important information in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Investing involves risks, including the loss of principal, and Schwab does not recommend the use of technical analysis as a sole means of investment research. Now, one other thing you need to know is that any investment decision you make in your self-directed account is solely your responsibility. Now, with all of that important stuff said, let's set an agenda for today's discussion. And I'm going to kind of mix up the order of things a little bit. Typically, what we do is we look at existing positions, we check out the markets, and then we explore a new concept. I'm going to tinker with that a little bit. We're going to start off with a quick market review because it's sort of doing its thing. I don't think we need to spend a lot of time on that. But then we're going to look at our existing positions. And one of those is going to lead us into this discussion. There's one of our existing positions that I think we might sell a covered call on. And I wanted to talk through this concept of, well, how might we increase the potential of income on that call that we choose? And how might a trader determine whether the pros and the cons are sufficient for their needs? Now, once we've done all of that and we've placed that new trade, we'll go back and with the remaining time, revisit the 8 other positions. I think there are probably a couple of other things that we need to do in that paperMoney account today. So while the camera's on, let's get it done. But let's get right to the markets. Let's go see what the S&P has been doing. Here we go. There has definitely been some back and forth from the executive office and the Fed. And it looks like the market's right now kind of shrugging that off. Still churning a little bit higher. So here we sit at, again, market is that all-time highs? Yesterday's high, 69.7836. We're just a few points, a fraction of a percentage point below yesterday's highs. But if we were to stay where we are right now, all-time high close on the S&P 500. Time will tell, still a couple of hours of trading left, so that story's not been told yet. But let's just say that our hypothetical covered call or short put trader here is just looking at things. Let's say that they think that things are looking fairly bullish, so they want to give their stock a little bit more upside potential, but we're still going to sell a covered call on positions where It might look like that may be the thing to do at this time, weighing the pros and the cons, of course. But let's just say that our income-seeking investor or trader here just thinks that stocks are more likely to go up than not. Time again will tell. We'll see. But that's going to be our example outlook for today. Oh, Rich, you say you're a new guy here? Excited to see what's happening? Well, this should be fun, Rich. So we're going to go look at a current trade right now. It's been a covered call in the past. A call just expired, so we're going to be selling a new one. So let's go have a look at our existing positions. So we have 9 positions right now. Some are struggling a little bit. Now, there are more extensive histories to several of these than what's displayed right here in these profit or loss numbers. Overall, doing just fine. But let's look at this one. You'll notice there's sort of the odd man out here, where under the quantity, this one says plus 100. The rest of them have no quantity displayed. That's because those all involve options, short puts or short calls. And those are not displayed on thinkorswim by default unless we click on the symbol and display the sort of the inner workings of those options trades. But this one doesn't have any calls or puts on it. And this webcast series is not called Buying Stocks. It's called Covered Calls and Short Puts. So let's either decide to kick this one out or sell a new call. Mark says, glad you're looking at B. This one's kind of interesting, right, Mark? If you were following along, when we set this one up, which was 2 weeks ago, we structured it with a stop order. Now, that stop level has been hit. So you might be wondering, why hasn't this been sold? Here's the history of this Visa position. All right, so we bought these shares right back here. Actually, it turned out to be at short-term peaks, not terribly surprising from a technical perspective because there was some resistance right there, and that was a concern at the time. Anyway, bought the stock right there, sold the call right here at the 357.5 level, and the stock fell away from that, pushed up right before expiration, and this was a trade that was intended for a fairly short period of time. But right before expiration, we got a few pennies in the money here, maybe for a few minutes or a few hours, but then pulled back and we hit our expiration, which is this blue dashed line that I've drawn on here. That was January 9th. This was out of the money, not assigned, not called away, left us with the shares. Now, at the time we placed that trade, we also had a stop in at 340. Well, if you look at the bottom of today's candle, that went down below 340. So why wasn't the stop triggered? That's because if you go back and watch that webcast from 2 weeks ago. So by the way, if you want to catch up on these, if you didn't get to see the logic of the trades as they were originally placed, do yourself a favor, if you haven't done this already, and subscribe to our Trader Talks channel on YouTube. So the full name is Trader Talks Schwab Coaching Webcast, and you can join our live streams here. You can also go through our playlist of previous webcasts. Now, the way to subscribe is just go down below the video right now and click on the subscribe button. It doesn't cost anything to do that. It only takes a second. But this is where you can go find these playlists. So like if I go to playlists and I scroll down a little bit, we're looking for covered calls and short puts. And right now, that's going to be just a little bit beyond the halfway point. There it is, down here to the lower left. Matter of fact, if you scroll all the way down to the bottom and just come up a few rows, there it is. We can click on View Full Playlist. And then from 2 weeks ago, there was this short-term trade on Visa that we did, selling weekly covered calls for income. We went through 8 critical considerations. We placed the trade with a stop. But just to bring you up to speed, the reason this stop wasn't hit with this morning's activity is because today's the 12th, after the weekend. Last Friday was the 9th, which is when this contract expired worthless, and the stop expired with it. We made the stop contingent upon price activity, but it included closing out the call option. That call option was no longer there. The stop expired. So it just left us with 100 long shares of Visa. So what should we do with these 100 shares? I was trying to make a decision this morning because markets were still active. Had we been below 340 at the time this webcast launched, I probably would have just sold the Visa shares. However, those have recovered. They're actually climbing up above this morning's open. And let's just say that our hypothetical investor here might say, well, okay, I wound up with some shares, not below the stop level at this point. Let's sell a new call. All right, so where might we choose to sell that call? I think a couple of different ways to do it. We might tie it to charts, and it looks like that previous resistance, most recent clear or stronger resistance might be about that 352.5 level. Mark says, sell them is my view. Mark, in other words, sell this, sell the stock shares. Yeah, sometimes you just do. Yep. For some traders, they might say, hey, I got lucky. I'm not down below 340 right now, but I was earlier today. Maybe they're not feeling good about ownership of these shares for that reason or for other things. They might just decide to sell. But I'm going to keep the shares, and let's sell a call maybe up here around that 352.5 level. Being aware, what did we pay for these shares? 354.5. So it would be accepting a contract to maybe sell the shares for less than we purchased them for. That doesn't mean we're going to lose money on this trade, because we've already realized a gain of $2.13. It reduced the break even on this trade to 352.41, and any new premium that we could collect can lower that break even point again. So if the options have made up for the loss that we're taking on the stock, it could still be overall be a profitable trade. But let's go look at this. Let's go to our trade tab. And how about we look to keep this short term initially again? We started off with a short term trade on this. Well, what if we do that again? So if we go to, let's say, let me open up the whole chain here. Let's see what our choices are. We just have a few days on some contracts. We do have the 11-day contracts, which was it actually was the time frame of the original trade. How about we just repeat that? All right. Let's go here, and Veer says Visa and all the news of the interest rate limit was the news. I'd buy on this dip. Okay, that's the way some people might see it. Obviously, I can't make recommendations in this webcast. This is for educational purposes only, but individual viewers can certainly have their own opinions, and they may turn out to be the right ones. There are risks associated with opinions, though, of course, but very good. Thank you for the comment. 23rd of January, let's do another 11-day contract, again, to maintain the consistency in the concept from the webcast that we did just a couple of weeks ago. So what if we look down here, and let's see, here's our 352.5 contract. That also, for those that use Delta as a general guide, has a delta of 26. Our delta can tell us how much we can make or lose on a $1 move on a stock on an option, or it can show us the relative probability of the contract expiring in the money. Or in other words, there's about a 26% chance that this contract would be in the money, or the stock be above 352.5 at the 23rd of January expiration. Vera, thank you. Appreciate it. All right. Looks right now, though, that if we sell that contract, that would be between 171 and 201. Let's call it $1.86. And if we do some math, that's about 0.5% on the current value of Visa. All right. Now, also, if we collect $1.86, that would lower the break-even point for this overall position since we started it. It would lower it to down a little bit below 351. Collecting that premium can help lower that break-even point. So maybe our trader hits the pause button here and says, not enough. Nope, not enough. I want more. Hey, welcome aboard. Somebody just says, new to Schwab, first time here. Great to have you. Very good. I'm Cameron, by the way. Good to see you. Anyway, let's just say that our trader wants to see if they can get more. Let's squeeze it harder. Well, if we want more juice out of a covered call or a call that we're selling, there are three ways to do it, because there are three big variables in the way the options are priced. We can work on changing the price variable in this contract. We can work on time, or we can work on volatility. Price, time, and volatility add up to the vast majority of the pricing of a contract. So here's the first thing that we might do. Let's go to our trade tab. first thing the trader might do to increase the income potential for their covered call is to lower the price that they're requiring somebody pay them for their shares. If we were to do the 352.5 call, what we're doing is we're entering into a contract where we're saying to another trader, okay, I'll sell my shares to you. I'll get into a contract with you to where you can buy my shares, but you're going to have to pay me $352.50 for those shares. Well, if we required them to pay a lower price, $350, $347.5, what if we just say $350? Let's make it just an incremental increase in the income potential here. Let's consider the 350 call contract. Well, first thing we'll notice is we're going from $1.80 and change to maybe $2.50 or thereabout. So that's a big jump in potential income. That's like nearly a 50% jump in income, which sounds great. All right, so someone who's highly motivated by income, that sounds like a positive, and it is conceptually, if that's the motivation and they're okay. But what's the trade-off? Well, we literally have agreed to sell our shares at a lower price. Now, we bought these shares for $340 or $354.5, and now we're agreeing to sell them for $350. We're selling them at a steeper discount, taking a bigger hit on the stock, but we are collecting a larger premium that can lower our break-even point more. There are pros and cons. All right. Mark's saying, I don't like the look of the bid-ask spreads here. Mark, that is just one of the things that comes along with, and Visa, it's not like this is a little thinly traded stock, right? This is one of the biggest companies in the world. But weekly contracts, particularly when they're first introduced or as they get closer to expiration, they can have wider spreads between the bid price and the ask price. So quite commonly in my webcast series, for that logic, you'll see me trading more of the monthly contracts than the weekly contracts. Not to say there's anything inherently wrong with trading weeklies, it's just that they're less liquid, and that creates wider spreads between the bid and the ask. Makes it harder to get into and out of them at times. Yep. All right, but good point. Good call out there, Mark. Anyway, yeah, and definitely something I was noting, but believe it or not, these spreads have narrowed up substantially from just earlier in the trading session when there hadn't been a lot of activity yet. So yeah, something that I was noticing too. All right, so there is the first thing the trader might do. Now let's exaggerate that a little bit more, and instead of just going one strike lower, let's go. How about we go right down to at the money, the 345 strike. That is paying how much more of an income? This was $1.85. This is $4.45. My rough math says that's about triple, pretty close. So same stock ownership, just different strike selection, and the trader's getting a much larger premium. So we're increasing the potential for income. I always say potential because even though the income is paid up front, it's not realized until the deal is over. Yeah, Mark, 3x. What's the trade-off here? Well, once again, we're agreeing to sell the shares at a lower price still. How much would this help? Aside from just getting a larger premium, let's say we get up to 470. Let's say we're able to fill this for 470. What does that do for the break-even of this trade? Well, we bought this for $350, $454. We've already realized a profit of $213 on an earlier call, so our break-even is at $352.41. If we sell this for $470, that would lower our break-even by my rough math to just under $348. And wait a minute. We're agreeing to sell this at $345. My math right? Let me just double check. I think I'm about right. 352.41 minus, let's say, a 470 credit would bring our break even to 357.30 or something like that, or 347.30. I mean 347.30. If we get called on this, and there's a pretty good probability that could happen, this would not be a break-even trade. So be aware of the pros and the cons of pursuing greater income. It can come at a greater risk. So, and by the way, if you catch me making a math error, I do a lot of this on the fly, just let me know. If you see me just make a mistake there. So there's one way that we might increase the income potential for a trade, and that's by looking at price, the price that we're choosing. What about, and I'm talking about the price of the stock, the price at which we're striking a deal to maybe sell our shares to another trader. What's the second variable? Time. Well, these are weekly contracts. If we get into a contract that gives someone the right to buy shares from us for 11 days, maybe we could entice them to pay us more if we sold more days of potential to them. So yes, we could go out further in time. What if we went out here to the monthly expirations, Mark? We go to those narrower spreads. Let's go to the 20th of February. This is nearly 4 times the amount of time on the contract. If we go to that 350, looks like we don't quite have that. So let's compare the three, I was going to say the 352.5. Let's compare it to the 350 that we were just looking at. So maybe just for reference, let's come back here to the original 350. We were looking at this one, and it's trading, we'll call it 260. Yeah, right around 260. Well, if we go out to pretty close, about 3.5 times as far out, and we look at that 350, that looks like that's trading between 730 and 775, a substantial increase in the potential income here. The premium is much larger. Proportionally, though, it's not, you might think going out 3.5 times is going to produce 3.5 times the income. Nope. Because of the way that time decay works with options, the closer we get to the expiration, on a day-to-day basis, the premiums are going to be bigger. The further we go out from expiration, on a day-to-day basis, the premiums are going to be smaller. However, we can still say it's a pretty significant increase in the premium collected. Going from, one more time, let's go back up here to our original 350, to about 260, to about 7, let's see, what was it? Might even be close to 760, 750, 750. Close to 3 times as much, more like maybe 2.8 or 2.9 times as much. So we've gone out 3.5 times as far for 2.8, 2.9 times the income potential. So the increase in reward is there as the trader is trying to make a decision for themselves, weighing the pros and the cons, what's on the other side of the equation. Bigger premium, but we also have to sit around longer. Instead of 11 days, we got to sit around for 39 days to get all, if we're trying to work our way all the way to expiration. Also, while we're waiting for that to happen, we're giving the stock more time to misbehave. And over the course of 39 days, let's play sort of a worst case scenario here. Let's look at this 39 days. That's this red dashed line out here on our chart. Where can this stock go that has fallen so far in just the last 2.5 trading sessions? Give it another 39 days. How far could it go down if it really had a mind to? If that continues to collapse in value, someone else may have the right to buy the shares from us for 350. Doesn't mean they have to. If the stock collapses, they say, Cameron, keep those shares. I don't want them. And all of a sudden, we're left holding the bag of shares that have dramatically dropped in value that we bought for 354. That's the trade-off. There is significant risk. All right, let's see. Veer says, I just noticed you don't have open interest in the options table. That may inform the trader on what others are doing. It's not absolute, but it can be informative. That's accurate in a lot of cases. Open interest can tell us how many contracts there are open at specific, at different strike prices at any given time. Now, the thing it does it gives us no insight into, and this is a major shortfall. So pay attention to this. If I open I don't mind taking just a moment to explore this for a second. Let's go here and maybe add, let's customize this, and we're going to add open interest. There we go. Let's add that and just click OK. So here's our open interest, and we can see, how many open contracts are at different strikes for the calls that we're considering. So there's our 350, and it says open interest of 1484. It possibly the strongest thing it tells us is the relative amount of liquidity. Now, we can also see that though in narrower spreads. When there are narrow spreads, there's an implication of strong liquidity. What open interest can't tell us is, oh, there's 1484. Oh, they must be really bullish on that. No, because we don't know whether these contracts were opened as a bullish position or opened as a bearish position. Maybe somebody sold some contracts there. It doesn't give us those sorts of insights. So serious shortcomings in that respect. We don't want to try to read too much, but I think you were hedging your bets already there on VIR 934, wasn't it? Your point here? Yeah, good call out again though. But I'm going to take off open interest if you'll forgive me. Let's customize the column sets again. And let's remove that, click OK. I don't want to be dismissive of open interest. It's just not, I didn't plan to discuss it in any detail today, okay? So price is one variable that the trader might consider and reconsider if they're looking for an increase in premium. Time is another thing that the trader might consider as they're looking for higher premium. But with each of these, there are pros and cons. And I know you want to give me a universal, yes, this is the magic formula for selecting for every trader. A plus B plus C equals D. I don't have that sort of an algorithm for everybody. We just have to weigh the pros and the cons for ourselves and make the best decision for our portfolio if covered calls are even playing a role at all. This is just a sort of educational academic discussion anyway. Final variable is volatility. More volatile stocks pay higher premiums. Stocks going through greater periods of volatility will pay higher premiums during those periods. So another thing that we might do is if we've looked at the time frame the trader prefers, if we've looked at the strike price the trader prefers, and it's just not giving what that trader considers to be enough premium, maybe they move on to, maybe it could be due to the fact that low volatility stock just doesn't offer high premiums. So they might choose to go to a higher volatility stock in pursuit of higher premium. Now, I think that leads to an obvious observation, and that is, doesn't risk attend higher volatility? It doesn't sort of come along with it hand in hand? Yes, it does. Yeah. Volatility can work in the investor or the trader's favor, or it can work against them just as easily. So yeah, one thing that we might do, if we're okay with, if we're looking for stronger premiums, maybe we choose more volatile stocks. We could look for higher beta stocks. If you know what beta is, measure of volatility. Another thing that we could do, let's go to the chart here of Visa, and I'm going to add a study. Let me know if you're familiar with this study, the implied volatility study. Let's add that to our chart. Click apply and click OK. And we get this green line, which is showing us relatively high periods of expected volatility for Visa. And these are the periods when premiums will typically be higher for Visa, and relatively low periods of expected volatility when premiums tend to be lower. Yep, it could be some interesting context for what we're looking at getting right now. What's been happening with our chart of expected or implied volatility most recently? Well, it's been on the climb. So what that might translate to is, if traders aren't terribly satisfied with premiums right now, maybe they don't sell covered calls on Visa just yet. They maybe wait for this to go up a little bit higher, or they may they can just assure themselves, well, at least the premiums are better than they were a couple of weeks ago. That would be a factually accurate statement in most scenarios for most strikes on Visa right now. So one thing I want to point out before I move away from this discussion of volatility is there tends to be some seasonality to it. And it's not winter, fall, spring, summer. Instead, it's earnings, 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 earnings. Yeah, Vic says implied volatility, does it increase due to earnings? Yep. Yeah, there tends to be sort of a wave-like behavior to implied volatility as earnings approach and as earnings pass, and as earnings approach and as earnings pass. It doesn't happen on every stock. Even on stocks where it has that tendency, it doesn't happen every time, but it tends to be fairly prominent on a lot of stocks. So you can just check this chart to see if that's been the case, because what's happening here is as earnings get closer, the expectation of volatility will increase among options traders. I don't think that's going to be a surprise to a lot of people. And when that expectation of volatility goes up, the speculators see it as potential and they trade more options. The hedgers see it as risk and they trade more options. Not always. Obviously, I'm kind of simplifying things, but that increase in traded options demand will increase the price of options. And so we see this sort of cyclicality between earnings announcements. So yeah, selling calls, for example, you typically get the highest premiums right before an earnings announcement. That's because the volatility is high. What comes with volatility? Risk. It's a compensation for risk in some respect. Yep. All right, so price, time, and volatility. 3 variables that a trader might consider when they're looking to sell options calls for income. And then we really just have to weigh, well, is it worth me having to sit there on shares longer in a longer term contract in pursuit of higher premium? Is it worth agreeing to sell the stock at a lower price? If I think it's going to go above that price, maybe I don't want to do that. Is it worth sitting through more volatile periods or selling calls on more volatile stocks in pursuit of higher premiums? Those are questions that can only be addressed by the individual trader themselves, according to the circumstances of their portfolio and the stocks that they're trading. All right, but let's go place our trade here. You know what I'm going to do? I'm going to back it all the way back and just say, let's go for that original premium. 23rd of January, 352.5 call. Maybe we can get about $1.80 for this right now. We just have 100 shares, so let's make sure that we just sell one contract. I'm going to click on that bid price. Let's take this down to just one contract for the 23rd of January. Let's say, how about we try to get $1.75 out of this? What did we get last time? 177? No, we got 213. 177 was on one of our other trades. Anyway, let's try to get at least $1.75, and I'm going to click confirm and send. We're going to sell the 23rd of January 352.5 call for $1.75. We're going to be lowering our break even. It's at about 352.5 right now. This will put it back down under, it'll put it under 351, but we're agreeing to sell our shares for less than we originally paid for them. I just want to emphasize that. We bought them for 354.5. We're agreeing to sell them for 352.5, but we've already collected and realized gains on one call contract, and we're trying to collect and potentially realize gains on a second call contract. There is a commission for getting into this trade, so that chips into that credit a little bit, but we're going to send this order off. Oh, and by the way, there's also this reminder down here, handy little reminders, this red bar. It says, please note that you've selected a weekly option series with a non-standard expiration date. Yep, just means it's not a traditional third Friday monthly contract. We did that deliberately, so that's okay. Let's click send and see if we can get filled on that. So while that's working, I want to look at a couple of other of our positions. First of all, a lot of these are doing just fine. AbbVie, I'm actually, even though that one's not doing as well, it's just a covered call. If you want to see that, bought the shares for 227, they're close to 220 right now. And the most recent call that we've sold, it's gone down a bit, but here's that trade. I wanted to show you that. That's been coming down. It's right near support. We have a plan to consider closing if that support breaks, but it doesn't look like it's broken yet. So we're going to let that one continue to work. By the way, we've also previously collected a 193 profit on this one. But a couple that I did want to look at were Amazon. Amazon is a short put. We sold it for $3.70. There's only 5 cents left in that thing. Here's what happened. This is a bullish trade. When we sell a put, it's a bullish trade. We entered here, we dipped for a couple of days, and then it took off. And this has gone so far out of the money that this put is effectively worthless. Not quite there, but only about $5 left in that trade. A trade can reverse if we give it time to. So maybe right now we're going to close this one up. Let's actually remove the implied volatility since we're past that part of the discussion here. Yeah. Sold these puts for 370. We closed one of the two puts out at 303. And maybe, time permitting, yeah, I think we have time. Maybe if the trader is still bullish on the stock, let's see, where's our most recent resistance? We have a broken resistance, new support, looks like around 335 or 235. How about if we sell a put there now? Let's close the one out that we're in and sell a new put up there at 235. So here's what we might do. Let's go to our trade tab. Actually, let's start from our monitor tab. Let's right click right here on that position and create a closing order to buy that put back. It looks like it might cost us 6 cents. We sold that for 370. This would be realizing a gain of over 365 if we're able to fill this order. So a person says, what was the reasoning when you entered Amazon? If you want to see that logic, you can go back and watch the archives. But basically, when a trader is bullish, looking for income, that's basic reasoning, but that's the long and short of it, basically. So let's buy back this one contract. If we're able to fill this, though, how about we sell a new one out there for the 20th of February? And let's do it here at this previous resistance, potential new support at 235. So here's how we might do that. Let's change this from just a single order into a first triggers sequential order. That means if this first order is filled, it'll trigger a sequential or a second order to go into effect. And for that, let's create an opposite order to sell. We started off with 2 contracts. Let's stay with 2 contracts. We just have one left of the 2 that we originally sold. But let's do the, let's see, that was going to be the 20th of February, I believe. Is that our next monthly cycle? Yep. Let's do that, 20th of February, now I have to remind myself again, 235 put. And with this one, it's trading for, let's look up here at our option chain. The 235 puts are between 420 and 430. Let's say that we're okay with a 420 credit, okay? So let's try to get at least a 420 credit. We'll leave that as a limit order, good for the day. On this one, it's trading for around 6 cents. Let's say we're willing to spend up to 10 cents to get out of the current contract. Sold it for 370. If it costs us 10 cents to get out, that's a realized gain of 360. And then we're selling a new one, hoping to get another 420 for that. Okay. E. Dunning, you're saying 560 and 570. Not quite following you there. Oh, anyway, let me just double check. Did I miss something? Somebody calling me out? Because when it's always possible, I just missed something. 235 put for the 20th of February. Oh, 560 to 570. Yep, absolutely right. Yep, that's what they were pointing out. I looked at the wrong strike, didn't I? So we're looking for, and by the way, had we put in a limit below, too low, it doesn't mean that we will sell for 470 or whatever I put in there. It means that, well, we put that in as a minimum. It very well could fill at 570. But how about we do 560? That's going to be a little bit below. There we go. Thank you for the calling me out there, though. Because sometimes I do, as I'm navigating around and explaining what I'm doing, and it's easy, just like you just saw, to look at the wrong strike, something like that. Yep, so just be careful when doing this at home. Double check as you're placing your trades. But let's click confirm and send. We're looking to buy back that the put that we're in for 10 cents. If that fills, that would kick in the second order to sell 2 contracts of the 235 puts for 560. Now there are commissions to be paid to get in, to get out of the one that we're hoping to get out of, to get into the 2 that we're hoping to get into. But we'll see if we can get a fill here. Let's see. Modified that trade. Let's let that continue to work. So yeah, offering to get out for 10 cents. It's only about 6 cents still. Yeah, that just filled. So now we're working on the second order. And it filled. All right, filled at 560. So very good. Now, we have one other position. We have an NVIDIA. I wanted to talk about NVIDIA a little bit here. 4 days left on this contract. We own the shares at 183. We've agreed to sell those shares at 195. The stock is only at 187. So here it is on our chart. Bought the shares here. Along the way, we've previously sold and closed out some calls for profits. So we've already had a realized gain of 343, realized gain of 340. Our most recent current contract is the 195 call. We collected another 193 for that. And it's been pulling back from that. Just a few days, 4 days till expiration. And it looks like if the trader wanted to, they may be able to get out for about 40 cents. Now that would be leaving, of the 193 that we originally collected, we were leaving $40 on the table. I was tempted to close this one out. I think we're going to leave this one on and talk about whether that was a good idea next week or not. Because close it out right now, well, we don't have to worry about getting assigned, but we are leaving $40 on the table. If we leave it till expiration, we may get called out, but we also are leaving on a high probability of an additional $40 of realized gains here. It's a probability. We'll see. All right, but guys, we're done. We've accomplished what we set out to do today. I wanted to take a look at what's going on with the markets, use an existing position to frame up a discussion of how might a trader increase the premium potential on covered calls that they're selling, and then decide for themselves whether that's sufficient income or not. And the way to do that is to realize price, time, and volatility all play a role, and changing any one of those variables comes with their own specific pros and potential cons. So hopefully that was helpful, everybody. This is what we do on our Mondays. I hope you enjoyed the discussion. We're going to do this again next Monday. We'll be following up on our trades. I'll probably go through all, we're probably going to wind up with, what, 6 left by next Monday's discussion. So we'll follow up on those. We'll plan and place a new trade. I hope you'll join me for that. But I want you to be aware of the full slate of educational resources you have available to you from Schwab Education. Starting with, if you haven't done this yet, make sure that you're subscribed to our Trader Talks channel on YouTube. So just go to YouTube, look for Trader Talks Schwab Coaching Webcasts, or just right now while watching the video, click on the subscribe button down below. But our YouTube channel is where you can join our live streams. You can also find our playlists of previous webcasts like I've demonstrated earlier. Now, another thing that I would strongly suggest you do, and I'm sure Brent would back me up on this, is you should be following your favorite Schwab presenters on social media. Another great resource for you, best place to connect with us in between the live streams when the camera's not on, is on social media. So you can find Brent and me on X. Just go to X. Brent's handle there is @BrentMooresCS. My handle on X is @CameronMayCS. So let me bring that up here. So there's my handle. You can just give me a follow here. And then if you reply to one of my posts here, I reply right back to you. And it allows for that interaction when the cameras aren't on. Another place that you can now follow me is on LinkedIn. It's only been a couple of months since this was rolled out. So you can find me on LinkedIn. Just go to linkedin.com/in and then go to Cameron May CS. So linkedin.com/in/Cameron May CS will take you to my profile. Give me a follow there. And if you reply to one of my posts right here, I try to reply right back to you as well. All right. Thanks, guys. Definitely appreciate your time today. I will see you in another upcoming webcast. I have something new every single day of the week, as long as the markets are open, as long as I'm not on vacation. I'm here delivering some new educational webcast. So I'll look for you at a future webcast. I'll also look for you on social media, on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.